Welcome to Warehouse Women, a podcast where we talk about commercial real estate, building businesses, and passive income, but most importantly, turning barriers into strengths. Last week, I shared lessons learned as a business owner. Today, I want to share lessons learned in real estate. My real estate company has 5 major departments: acquisitions, investor relations, development, asset management, and operations. When I was starting my company, I knew I wanted it to be a fund and syndication company, which is just a fancy way of saying I knew I wanted to do group investments in commercial real estate. Early on, I tried to go through my P&L, my profit and loss statement, and assign an ROI, or a return on investment, for each line item, something I learned from the podcast Empire Building. But I was too new. I didn't know how to effectively do this, especially for things like lawyer fees or conferences. What I learned instead was to create a P&L for each department, a profit and loss for each department. The way syndications are structured, they have a fee for everything, but this is for a reason. The fees are to make sure that the departments that are putting together the deal for the investors, for the company, are making sound decisions and can support themselves to fulfill and execute the deal. So for acquisitions, there's usually a charge of 3%, which is industry standard. But what I realized was that our acquisitions team needed to understand that 3% was supposed to cover their salaries or any tools that the department used and any other expenses that department would need in order to bring in deals. Once I realized this, I broke it down for every department. Investor relations needs to understand that the capital transaction fees play a large part in how their P&L works. The development team needed to understand how the development fee supported their team. The asset management department needed to understand how asset management and property management fees were a part of their P&L. Now, in the beginning, yes, I had 5 departments, but I was the head of all of them, and I worked in all of them. So I needed to understand how these separate things worked together to support each of these individual departments, but also I needed to make sure, since at that stage I was the only one doing it, that I brought in deals that made enough of a profit margin to support the company as a whole. So it was important that if I did non-syndicated deals, that I understood the profit margin that would go to the company and how it would sustain and build the company in order to support all the departments and their own P&Ls as the business grew. So it was a very overcomplicated way of saying I need to make sure that whatever real estate deal I do doesn't just look good on paper, but supports the company in its growth. So that was my first lesson learned as a real estate company, is to figure out deals that don't only look good, but that also can support the growth of your company. Whew, that was a long-winded way of saying that. Let's dive into the details. The second major lesson I learned in real estate was the acquisitions process. The acquisitions process begins with the top of your funnel. So calling your brokers, calling the owners, whatever the list is that you're using to bring in new deals for yourself. Continue that, make sure it's based on relationships, find good data, put that all into your lead funnel. The next most important step is never stop underwriting deals. Underwriting sounds scary, but it's literally just running the basic numbers on a property. You can literally do this on the back of a napkin. It counts. But I do suggest an Excel sheet so you can identify which numbers are important to you as you do this over and over, and get them from a broker or owner in the first call so you don't have to call back for everything that you need to underwrite. Next, I want to talk to you about making offers. Make sure that along with your conventional offer, you offer creative deals or creative financing. So in my offer letters, I always give 3 options: conventional, owner financing with 2 different terms. So whether that's different interest rates, different balloon times, different contingencies. I always give 2 owner financing options and 1 conventional option. Now, another strategy is to build the 3 option strategy in a different way. Give them 2 options that they could get elsewhere. For example, if you don't want to do traditional or conventional lending, you can say, hey, if you get someone else to buy this at a conventional lending rate, this would be your price. And if you get someone else to do creative financing with, a really high interest rate or a really short term, like 5 years, this would be probably the price you would get. But I'm not going to give you those options, but you can go to other people for those options. But what I'm willing to do is insert your option that you want to sell them on. Don't make up things, obviously. Make sure that these are valid numbers and that had you the option or strategy to do the other 2 options, that they are viable in the market. And present your one option like, hey, I might not be the best buyer for you, but this is what I can do to buy your property. It will filter deals for you a little bit more than the previous 3 option strategy. But if you know how you want to buy deals, and that is the only way you want to do it, it's a good way to get things moving quickly. How to deal with unrealistic ideas from the opposing side. The simplest way for me to say this is just put the ball back in their court. If they have unrealistic ideas, just ask them, like, can you show me how you got these numbers? When you ask them to send you like a pro forma or like a back of the napkin explanation of the numbers of like how they're getting what they're getting, then you can go in and be like, this is great, but this is not market value, or this is not the market price, or yes, but you don't understand that I also have investors that I need to make sure they get a certain percentage return. So if I do this, yes, like if I was doing it alone, I could make, 8 to 10%. But if I'm doing this with a group of investors and I want to make sure that everyone is getting a minimum of 20% cash on cash return, then I need to make sure that this deal is making enough money to pay everyone. And when you explain it like that, any good broker will either be able to show you how you can make that happen, or will tell you that, this is not the best deal for you, or they will find creative terms that will allow you to do that. And finally, follow up. Even if it's been 6 months, just check in. Hey, I heard that was under contract last you mentioned. How's that going? Do you have anything else in this parameter? Insert your buying criteria there and ask them what's going on with the last deal you checked in on them with. How are they doing? What's going on? And is there anything new within your criteria that has popped up for them or is coming up? So, the acquisitions process. Calling brokers and owners. Don't stop underwriting deals. Make creative deals and offers. Deal with unrealistic ideas by putting the ball back in their court, and continue to follow up. It's a pretty simple process, and I'm sure you can do it. Next, investor relations. Simplify investor relations. It is so easy to overcomplicate. All you need is to connect with people who want the benefits that you can provide them through your service and have the money to invest with you. At its core, it's that simple. But what you must do are these 3 things. 1, make sure they are a good fit. Talk to them about their investing strategy, their investing goals, what their expectations are from you as an operator, what their expectations are in terms of return timelines, what is their risk tolerance levels, why are they investing with you and not someone else. Make sure that they understand your investing values and make sure their investing values align with yours, whether it's a value add strategy, whether it's depreciation up front, cash flow in the back, whether it's selling off in 3 to 5 years, whether it's a long-term, 10, 20, 30 year investment together. Make sure your values align. The second thing you must do is communicate. anytime anything happens or doesn't, constant updates on the progress. Over communication is what you need in order to do the bare minimum here. And the third thing is to educate. Create a space where, if they want to, people can learn more about the details behind the numbers. Why can this fund offer this ROI, COC, or IRR, but not others? What is the business mechanism that works behind the scenes to support the investment they have made? Oftentimes, people do actually want a better understanding of this, or they want to hear you say it in a way that makes sense, and then they can forget about it because they've put their trust in you to make sure it happens. But make sure you have that option to educate people who want to, because a lot of people in our space just are curious and want to learn. And the more they know about something, the more they know that you know about something, the more they'll know you and the more they'll trust you. And always make sure you are in compliance with any laws that apply to you. So, simplify investor relations. Connect with people who want the benefits you can provide them. Make sure they have the money to invest with you. Make sure you're a good fit. Over-communicate, educate, and stay in compliance. That's it. That is investor relations. Now to go on to the asset management process. Asset management is different from property management. Property management is making sure the grass is cut, the electricity bill is paid, making sure the tenants are paying their rent, making sure anything coming in and out of the property itself is on point with your expectations. Asset management is understanding which properties bring in what kind of revenue, what you can do to develop the property so that it can bring in more revenue, what can you do to change the operations or the property management of the company so that it can bring in more revenue or decrease expenses. Asset management is about looking at the portfolio of assets and figuring out how to optimize what is coming in and out in terms of revenue and expenses in the portfolio as a whole and for each asset. Asset management is also understanding the customer journey. That is crucial to understand how to market to your ideal client, what they need in the process in order to actually come on board and then stay on board. And property management, again, is finding the ideal tenant. It's creating the SOPs, the standard operating procedures for how you're going to run a specific property. So, asset management, property management, two different things. Asset management can outsource property management to a separate company as long as they have a scorecard or some way to hold the property management company accountable for the basic needs. But what's most important with asset management is understanding the revenue and expenses and potential for revenue and expenses within each asset. And finally, how to create KPIs or key performance indicators. There's the leading and the lagging key performance indicators. Lagging is the result, what happens, what you want to happen. Leading is the actions you take to get to that result. So start with your lagging indicators, what you want to happen, and work backwards to identify leading. For example, if you need 10 investors to reach $1 million fund, each one coming in at $100,000, how many people do you need to have a conversation with in order to find 10 who align and have the means to invest with you? So focusing on the lagging every quarter, so how many investors have we gotten commitments from, versus leading every week, how many investors have you contacted that are our ideal client? So every week, focusing on the leading and how we can get the leading numbers up will help in the long run, the lagging measure come to be. So once you have your leading measures with your team, focus on them every week And then every quarter, evaluate if you're employing the right strategy to meet those lagging indicators. Don't overcomplicate KPIs, but be very intentional about it. So I hope that these 5 lessons learned in real estate is helpful to you. 1, make sure that the deal that you're doing not only looks like a good deal, but also supports the growth of your company. 2, the acquisitions process is about underwriting and creative finance. So find a way to make the deals work. 3, simplify the investor relations process. Do not overcomplicate it. 4, understand the difference between asset management and property management. 5, learn how to create effective KPIs. I hope this was helpful for you, and I will see you next time. If you enjoyed this episode, please share it with a friend, and I'll see you next week.